Egypt's trade deficit has caused a long-term debt problem. Foreign aid and Egyptian expatriate remittances have partially offset this deficit. Millions of tourists from Europe, Asia, and other Arab nations bring in revenue each year. The IMF gave Egypt a $12 billion loan in 2016, but it required the Egyptian pound to float freely, causing inflation and a rapid drop in its value. The government then cut energy subsidies to restore finances. The 2020 pandemic devastated the tourism industry, a major source of revenue, forcing the central bank to prop up the currency. This repeated the errors that caused the devaluation. Egypt imports the most wheat and has 109 million people who suffered from a wheat shortage and rising commodity prices. After agreeing to let the foreign exchange market determine the value of the Egyptian pound, the country received a $3 billion loan from the IMF last October. The pound fell to a new low, losing nearly 35% since the deal was reached. Analysts say the pound will fall further before stability as the central bank slowly withdraws support. In December 2022, urban inflation reached 21.3%, a record high. This currency weakness is hurting millions of Egyptians. 60% of 100 million people are poor. These people starved during inflation. Egypt gained independence from Great Britain in 1922, first as a monarchy, and then as a republic after the 1952 revolution. Since the agreement, the pound has dropped 35%. Analysts say the pound may fall further before stabilizing. In December 2022, urban inflation reached 21.3%, the highest level in years due to currency weakness. Inflation makes it hard for Egypt's poor to buy food. Egypt has had political unrest since independence from Great Britain in 1922, and since 2014, the government has been criticized for authoritarianism and human rights abuses. Furthermore, over 40% of Egypt's revenues go to debt interest payments. The October loan agreement was Egypt's fourth since 2016 and helps explain current issues. Egypt relied on Saudi Arabia and the UAE to cover budget gaps. Saudi Arabia alone gave Egypt $25 billion between 2013 and 2016. Egypt is a geopolitical power with powerful and wealthy allies like Saudi Arabia, the United Arab Emirates, the US, and China. Egypt was the first Arab and African nation to establish diplomatic relations with China in 1956. The Saudis, Emiratis, and Americans prefer the Egyptian regime to the Muslim Brotherhood they overthrew in mid-2016. Their economy suffered, particularly its manufacturing sector, which led to formal IMF negotiations. In November, the IMF program set the terms. First, it promoted inclusive, private sector growth. Second, increased labor force participation, especially among women, attracts foreign direct investment, and strengthens Egypt's macroeconomic stability. Egypt raised $6 billion for IMF approval and received UAE, China, and G7 support. The three-year, $12 billion IMF loan to Egypt included monetary, fiscal, and structural reforms. Egypt would adopt a floating exchange rate and control inflation. The country cut fuel subsidies and increased spending on vulnerable groups like women and children to reduce public debt. Egypt was to streamline industrial licensing, finance SMEs, decriminalize insolvency, and simplify bankruptcy laws. After switching to a floating exchange rate, the Egyptian pound devalued, costing the country billions to maintain its currency peg and stabilize at a lower rate. The black market exchange rate started lower and fell less than the official currency value. As the currency plummeted, ordinary Egyptians lost a lot of money. However, international investors were more willing to invest and exports were cheaper. Egypt became cheaper, attracting tourists from around the world. Remittances and investments from Egyptians abroad increased and inflation rose as well. In December 2016, Egypt's inflation rate rose to 22% and stayed above 30% for most of 2017, causing public concern and hardship. The 2016 devaluation and IMF reforms disciplined government spending and introduced pro-growth policies. The IMF helps crisis-stricken nations implement policies that restore economic stability and growth. IMF offers funded and unfunded programs. Funded is when IMF makes a loan and supervises spending. Unfunded is when they just supervise while other lenders make the loan. Big lenders and investors are more willing to invest when they know the IMF is monitoring a country's economic policy, especially if the economic data is unreliable. They verify inflation, current account, reserve, etc. After the 2016 devaluation, emerging market hedge funds were the first to invest because they understood the risks, while other investors who had been burned were staying away. Egypt's high-interest local currency bonds attracted hedge funds. Repack structured finance allowed them to negotiate exchange rate guarantees when the bonds matured. Hedge fund investors earned 16% per year on these bonds without foreign exchange risk. Given the low interest rate environment, this was a high return even though these bonds were not dollar-denominated and investors could not sue in New York if they went unpaid. Emerging market hedge funds profited from this investment in 2017 and 2018. The Egyptian central bank honored short-term, 3-month and 6-month bills and paid out dollars when they expired. Egypt's decision to pay high interest rates and guarantee exchange rates for certain investors violates their currency float agreement. To attract large oil and natural gas companies, the Egyptian government paid $300 to $500 million per year in debt. Egypt needed capital, so offshore exploration investments increased fossil fuel exports. They used hedge fund money to show financial stability and repayment to long-term investors. Egypt's workers' remittances rose 13% to $8 billion in the second quarter of 2017. The government's actions eliminated the currency black market and increased bank dollar liquidity. The government cut subsidies and public sector spending and raised revenue with new fees and a value-added tax. Telecom licenses and land sales generated more revenue, but inflation-stricken poor people were hit hardest by a value-added tax. The IMF program ignored Egypt's military's economic involvement. The military was also allowed to engage in economic activities to reduce the defense budget and provide senior officers with additional income. They started by reclaiming land and then rebuilt Suez Canal infrastructure damaged by Israel. Its economic role increased under a 2013 coup leader, and a 2015 presidential decree allowed the military to form companies or partnerships with local or foreign investors and share revenue. The military kept the land after selling these companies, and its businesses were tax-exempted. State-owned banks subsidized military-owned businesses, thus distorting market forces. The military has been criticized for undermining the private sector and discouraging foreign direct investment, which is necessary for sustainable foreign currency. Military-owned companies benefit from free labor and tax breaks, and analysts say they operate inefficiently like the Egyptian military, which would struggle without these benefits. The IMF's inaction was wrong. Egypt's economy grew from 2017 to 2019, but the COVID-19 pandemic in 2020 slowed it, especially in the tourism sector. The central bank borrowed billions of dollars to prop up the Egyptian pound, repeating the mistakes that led to the 2016 devaluation. Analysts also noticed that the Egyptian pound was not fluctuating, unlike other currencies, which made investors doubt the nation's financial situation and withdraw their money. As a result, Egypt lost $5 billion between September and December 2020. In 2022, Russia's invasion of Ukraine caused global investors to withdraw more money from Egypt, and wealthy Egyptians moved their money to Russia and Ukraine, their main wheat and tourism sources. Egypt heavily subsidizes bread, so the Ukraine war hurt its economy. They have subsidized basic loaves since the 1980s. Before the Russian invasion raised prices, this cost the government $5.5 billion per year. It is one of the world's largest grain importers, and the war drove wheat prices up, straining its foreign currency reserves. The issue was sourcing wheat, not price. Egypt bought wheat from Australia and the US at higher prices and shipping costs. In a country where 60% or 60 million people live below the poverty line, rising food prices could spark riots and overthrow the government. To address this, the central bank started requiring importers to deposit the full cost of the import transaction with their bank before receiving a bank letter of credit. Importers had to deposit the entire import transaction, including interest, in the required foreign currency with their bank to get a bank letter of credit. The central bank might still deny the request. In March 2022, the central bank allowed the Egyptian pound to fall, confirming importers' suspicions that it lacked foreign currency. The government's exchange rate was still too high, so this devaluation did not increase dollar availability like it did in 2016. This would cost billions of dollars that the government couldn't afford and deny the private sector money for imported goods. Egypt requested another $15 billion IMF loan and announced $22 billion in non-grant Gulf funding the same week. The central bank governor resigned and became a presidential advisor in August. In October, the IMF granted Egypt a $3 billion loan instead of the $15 billion it requested. The IMF said its reform program with Egypt would promote private sector-led growth and job creation through deep structural and governance reforms. Egypt, the IMF's second-largest debtor after Argentina, is increasingly dependent on Saudi Arabia, UAE, and Qatar. China's willingness to lend to Egypt is limited by their domestic and international bad debts. Chinese banks financing the new administrative capital are worried about Egypt's debt. Economists say Egypt has overspent on large infrastructure projects like an $8.5 billion sewer canal, expensive military weapon systems, nuclear reactors, and the $60 billion new administrative capital. Cairo agreed to structural reforms to reduce state entities, including military-owned companies and the economy, the IMF announced earlier this week. Egypt needed a permanent switch to a flexible exchange rate regime to build resilience and a buffer against external shocks. The fund warned that rising living costs could cause political and social backlash. The central bank may face political and social pressure to reverse the move to a flexible exchange rate. The IMF said structural reforms will take time to implement and produce results. While vested interests may oppose state reduction reforms, Egypt's economy needs many difficult changes to recover. To allow private sector growth, the state must improve business conditions, reduce corruption, and eliminate military competition. Thanks for watching.